Hello everyone, today we will discuss another topic under banking and insurance law. Today's topic is marine insurance. We have been discussing about different kinds of insurance so far. Today we will discuss about marine insurance. The list of topics to be covered here is introduction, meaning of marine insurance, cargo insurance, and there are certain features of marine insurance. We will discuss about that. Marine insurance definition refers to the insurance of goods dispatched from the country of origin to the country of destination. The term originates from the fact that goods intended for the international trade were traditionally transported by sea. Despite what the name implies, marine insurance is applicable to all modes of transportation of goods. When the goods are sent by air, their insurance is also known as marine cargo insurance. Insurance is often compulsory in many export trade contracts. It can be the obligation of the exporter or the importer to pay the insurance cost on the shipment, depending upon the terms of the contract. However, the need for insurance goes beyond contractual obligations, and there are several valid arguments for buying it before dispatching the export cargo. A contract of marine insurance is an agreement whereby the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed against transit losses, that is to say, losses incidental to transit. A contract of marine insurance may, by its express terms or by usage of trade, be extended so as to protect the insured against the losses on inland water or any land risk which may be incidental to any sea voyage. Cargo insurance. Cargo insurance which provides insurance cover in respect of loss of or damage to goods during transit by rail, road, sea or air. Thus, cargo insurance concerns the following: export and import shipments by ocean, going vessels of all types, coastal shipments by steamers, sailing vessels, mechanized boats, etc., shipments by inland vessels or country craft, and consignments by rail, road, or air, and articles sent by post. Features of marine insurance. Offer and acceptance is it is a prerequisite to any contract. Similarly, the goods under marine insurance will be insured after the offer is accepted by the insurance company. For example, a proposal submitted to the insurance company along with premium on 1st April 2011, but the insurance company accepted the proposal on 15th April 2011. The risk is covered from 15th April 2011, and any loss prior to this date will not be covered under marine insurance. Payment of premium. An owner must ensure that the premium is paid well in advance so that the risk can be covered. If the payment is made through check and it is dishonored, then the coverage of risk will not exist. It is as per Section 64 BB of Insurance Act 1938. Payment of premium should be done in advance. Contract of indemnity. Marine insurance is a contract of indemnity, and the insurance company is liable only to the extent of actual loss suffered. If there is no loss and there is no liability, even if there is operational of insured peril. Example, if the property under marine insurance is insured for rupees 20 lakhs and during the transit it is damaged to the extent of rupees 10 lakhs, then the insurance company will not pay more than 10 lakhs. Only the amount which is relate extent to the damage will be paid by the insurance company. Next is utmost good faith. The owner of the goods to be transported must disclose all the relevant information to the insurance company while insuring their goods. The marine policy shall be voidable at the option of the insurer in the event of misrepresentation, misdescription, or non-disclosure of any material information. For example, the nature of goods must be disclosed. That is, whether the goods are hazardous in nature or not, as premium rate will be higher for hazardous goods. Sometimes, while the transit of the dangerous goods, the insured sometimes does not disclose all the information related to the dangerous goods. In that case, the insurer will not be liable to pay any loss amount in case of damage or any peril. Next is insurable interest. The marine insurance will be valid if the person is having insurable interest at the time of loss. The insurable interest will depend upon the nature of sales contract. For example, Mr. A sends the goods to Mr. B on FOB free on board basis, which means the insurance is to be arranged by Mr. B. And if any loss arises during the transit, then Mr. B is entitled to get the compensation from the insurance company. Next is contribution. If a person insures his goods with two insurance companies, then in case of marine loss, both the insurance company will pay the loss to the owner proportionately. For example, goods worth rupees 50 lakhs were insured for marine insurance with insurance company A and B respectively. In case of loss, both the companies will contribute equally and pay the loss amount to the insured. Period of marine insurance. The period of marine insurance in the policy is for the normal time taken for a particular transit. Generally, the period of open marine insurance will not exceed 1 year. It can be also issued for the single transit and for specific period but not for more than a year. Deliberate act. If goods are damaged or loss occurs during transit because of deliberate act of an owner, then that damage or loss will not be covered under the policy. To get the compensation under marine insurance, the owner must inform the insurance company immediately so that the insurance company can take necessary steps to determine the loss.